The pitch was simple. You can earn 9 to 12% a year, more than bonds, more than savings. And unlike hedge funds, you can get your money out every quarter. It sounded like an upgrade. It wasn't. On February 19, 2026, Blue Owl Capital did something that had never been done before at a firm of its size. It permanently closed redemptions on its $1.6 billion private credit fund. Not temporarily, permanently. Investors trying to get their money back were told, no. To understand why this matters, you need to understand what private credit actually is. It's lending, but done entirely outside the banking system. No public disclosure, no daily price, no regulator checking the loan quality. A $1.8 trillion shadow market that grew tenfold since 2008. After the 2008 crisis, regulators forced banks to hold more capital and pull back from risky lending. That left a vacuum. Private credit funds stepped in, lending to mid-sized companies that banks wouldn't touch, charging higher rates, and pocketing the difference. For years, it worked beautifully. Returns were strong, defaults were low, and then came the next move, selling it to ordinary people. High net worth retail investors were invited in through semi-liquid funds, quarterly redemption windows, accessible yields, democratic finance, they called it. When markets turned volatile, and when the Iran war oil shock hit, retail investors did what retail investors do. They wanted out. Blue Owl's fund saw a 200% surge in withdrawal requests, and the fund discovered something its marketing materials hadn't stressed. The loans it held couldn't be sold in a hurry. Private credit loans aren't bonds. You can't sell them on an exchange. There's no liquid market. The whole model depends on investors staying calm and staying put. The moment everyone tries to leave at once, the structure breaks. Blue Owl wasn't alone. BlackRock restricted withdrawals on its $26 billion fund, returning only half of the $1.2 billion investors requested. Morgan Stanley capped redemptions at 5% when investors requested nearly 11%. Blackstone faced its largest redemption request in history, $3.8 billion, and had to inject $400 million of its own money just to avoid locking the gate entirely. Then the DOJ flagged something that made it worse. Many of these funds have been quietly hiding problem loans, not through outright defaults, but through a mechanism called PIK, payment in kind. Instead of paying interest in cash, struggling borrowers pay in more debt. The loan looks healthy on paper. It isn't. The DOJ called this shadow defaults. The loans aren't written off. They're restructured in ways that don't technically count as a default, but the borrower can't actually pay. The fund's reported performance looks fine. The underlying reality isn't. The 2008 comparison is everywhere right now. Private credit is about $1.8 trillion. The public corporate bond market is $13 trillion. So it's smaller, but the same structural flaw exists. The liquid assets, sold to investors who were told they could leave whenever they wanted. The semi-liquid label was always a marketing term, not a financial guarantee. The quarterly redemption window was real, but it was capped at 5% of assets. If more than 5% of investors wanted out at the same time, the gate came down, and nobody in the sales pitch led with that. The next front in this story is already being fought. Washington has been debating whether to allow private credit into ordinary 401k retirement accounts. The argument is that retail investors deserve access to these returns. The counterargument is what just happened to everyone who thought they could leave. Blue Owl's redemption freeze is still in place. The broader private credit market has stabilized, for now. But the retail experiment in shadow banking has revealed something the industry spent years obscuring. When you lend to illiquid borrowers, you are an illiquid investor, no matter what the quarterly window says.